Hi, welcome back to our YouTube channel. Our topic for today, differences between futures and stocks. Now, we need to understand the differences between futures and stock for both even beginners and even for those experienced traders. Because for beginners, you need to understand what is the difference between futures or whether we need to delve ourselves into futures trading, we need to involve ourselves in futures trading or not, or we should only invest in stocks itself. But for experienced traders, if you do not understand the main difference between futures and stocks, sometimes if we are using the investing method or trading method in stocks and apply this in futures trading, you're going to see that you're going to face with a lot of challenges. There's a reason why today we're going to cover the differences between futures and stocks, and in future we are going to see what kind of trading strategies are going to involve in both futures and stocks, that they are different. So let me start with today's topics. Before that, if this is your first visit, please remember to subscribe to our YouTube channel and on your notification bell. My name is Ting Ting. As usual, we need to start with a disclaimer. Our topic for today is only meant for education purposes. There's no buy or sell call. Now let's start with the first difference. Today we are going to cover those primary differences in between stocks and futures. And when it comes to futures, we are going to focus in terms of 4 different products mainly traded by retails, which are FKLI, FM70, FCPO and FEPO only. So the rest of the futures products we don't cover, like those interest, etc., your gold, etc., we don't cover because these are more relevant to your stocks itself. So let's start with the difference between stocks and futures. Once you understand, then you will know that even the method of tradings, you cannot use stocks method to trade in futures. If you're using stock method to trade in futures, you're going to face with a lot of difficulty, and definitely this is going to generate losses in your futures trading as well. Now, the first difference is for stocks, you know that you can only trade for one direction. So technically, to be more precise, is there's only one direction that you can make profit. So meaning, for example, if when it comes to stock trading, if you buy at a lower level, if it is an uptrend, then definitely you are going to generate a profit. But if it is a downtrend, you can't make profit. Although when it comes to stocks, we can say that we have IDSS, we have RSS, intraday short selling, we have regulated short selling. But you should understand that intraday short selling, it is only limited to intraday only. And regulated short selling, you have a lot of restrictions like uptick rules, you need to borrow your stocks before you can trade, etc. So there are a lot of limitations, especially when it comes to stock trading, which technically you can only make profit in one of the direction, because the other direction you can't make any profit. But unlike in futures trading, you can trade both directions. So in short, you can also profit from both directions itself. So for example, uptrend you can buy or you can long. Downtrend, you don't need to borrow anything. You can directly short the futures, or you can directly sell your futures contract itself, and you can still make profit. So if you really compare, for example, if you can only trade one direction, technically, if I'm going to convert this to opportunity, so meaning here you have one opportunity to trade. But if in futures market, you can see that both direction you can trade. If both direction you can trade, you have 2 opportunities. Can you see the difference or not? So when it comes to stock and futures, these are the differences, and you need to understand that one is you can only trade one direction. For futures, you can trade both direction. You can profit for both direction as well. And one thing you need to understand, for all the markets, we have both direction, and nowadays market volatility is higher. It's very common for us to see that after a long uptrend, we are going to see a downtrend. Then subsequently, you have a short uptrend, then short downtrend, etc. So it is very important for us to have different products in our whole portfolio, so that at least we don't underperform our whole portfolio compared to the market itself, or compared to a benchmark that we are benchmarking against. So this is the first difference between stocks and futures. Now let's look into the second difference. The second difference is when it comes to stock, technically there's no expiry date. So long as the company is still there, is still listed, you can hold on to the stocks as long as you want. So for example, you can hold on until 20 years, 30 years, then you pass it down to your son, to the grandson, etc. You can still hold on to it. But unlike stocks, futures, we have an expiry date. So you can see that, for example, if I'm long, let's say for example a January contract. So if I long FKLI January, I can only hold until 31st of January technically. So subsequently, you need to roll over. It's not that you cannot hold on to it, but technically you need to roll over. Although it's just a minor technical stuff that you need to do, which is you just need to renew your contract, but there's an action that needs to be involved, and technically there's a cost, a minimum cost that involving in rollover. So, but one thing is good. Some of you like to ask me whether should I start with stocks or should I start with futures, or is it a must for me to start in stocks then subsequently only can trade in futures? But my answer to you, sometimes in fact, I really strongly encourage some of them to start in futures trading. One thing different between stocks and futures is futures will force you to face with reality. So once you can master your futures trading, stocks to you is easy peasy, to be very honest to you, because you can see, especially when the contract expired, when you want to roll over, you are closing one contract. When you close one contract, technically you are going to see some realized profit or loss, especially losses. They force you to face with reality. In fact, for stocks, even you're suffering 90% of drawdown, or even that particular stocks, you're already suffering 90% of losses. To yourself, you tell yourself, so long as I don't sell my stocks, I still got the opportunity. Then for us, normally we do not want to face with the reality. We just ignore the stocks itself. We just pretend that we never own the stocks. But futures, one thing is good is this expiry will force you to face reality, telling you that actually something is wrong with your contract. Are you sure you still want to renew a contract or not? So sometimes there's a good part and the bad part. We just need to understand. That's the reason why today I'm trying to differentiate this for you to understand. So once you understand, you can fully utilize their advantages and try to see how do you overcome their disadvantages part. Now, the third difference in between stocks and futures is when it comes to stock, we have this term called margin account. So technically, stocks, for example, if you buy worth of 30,000 value of stocks, normally overall, or I would say the majority of you, you're going to pay up the whole sum of it. But many of them, actually, you might not aware, many of them, they are using margin account. Margin account, in a way, actually they are borrowing the money from the brokers itself. So when you borrow money, definitely there's an interest charges. So you're going to see that once you use a margin account in stocks, in stock investing or stock trading, you're going to pay an interest on it. So because you're borrowing money, am I correct? But unlike futures itself, we have this term called initial margin. But this initial margin and this margin account a bit of different, because this margin account is like your 30,000 worth of stocks, you pay a fraction. Let's say you borrow 90%, you only pay up 10% to own 100% of it. So this you're borrowing. But initial margin when it comes to futures is like a deposit. So the same thing, let's say you bought a product worth 30,000, but the nature of futures itself is leverage. So you can leverage, you're using this leverage itself to pay a fraction of it, which is what we call it as initial margin, or what we call it as a deposit, but you don't need to pay any interest. Because the nature of it. So, because futures itself is a leverage product, so you don't need to pay any interest. But margin account itself is not a nature. The stock itself is not a leverage product. That's why when you use a margin account, you need to pay the interest. Can you see the difference or not? Now, the last one, this is the main difference. When it comes to stocks, you're going to see that you're going to analyze individuals or different industry, different sectors, different management team, different P&L, etc. for individual companies. You need to go into details. That's why you're going to see that a lot of workload that you need to do for you to own the stocks, for you to invest in the stocks, for you to select the stocks. But unlike futures, technically for futures, we have two main groups, which is the index futures and commodity futures. Now, when it comes to index futures, you don't need, even you're owning the stocks, you're owning a pool of stocks, but you don't need to really look into the individual of the company. You don't need to look at the individual industrial sectors itself. You just need to look at the general market as a general. So you look at the general, less things that involve, less analysis that you need to do as well. Even when it comes to commodity futures, do you aware that, like for example, in stocks you have commodity companies as well, and which you're going to look at the individual companies because the management different, performance different, individuals company perform very differently. But commodity futures, generally you only look at the market demand and supplies of the commodity itself. So you're going to see that the coverage is different. You don't need to look at very specific like the management, the industry itself, the sectors itself. That's the reason why you can see that sometimes the commodity futures itself is trending upwards, but the individual commodities companies, they are trending downwards. So there are differences between stocks and futures. That's the reason why I reiterate that you cannot use the stock trading methods or stocks investing methods to invest or trade in futures itself, because their method is different. If you're going to use the same methods to trade, you're going to see that you're going to suffer a lot of losses as well. So I'm going to see you in our next session. Please remember to subscribe to our YouTube channels and don't forget to give us a thumbs up. My name is Ting Ting. I'm going to see you in our next session. Bye bye.